The first story should be linked to the Nifty 300 point gap down that happened. That is again because of the interest rate cut decision by Fed. So we know in US the interest rate was around 4.5. Then Fed cut the interest rate by 25 basis point and it is now down to 4.25. But usually when there is an interest rate cut, we see markets shooting up, going back up. But surprisingly, US markets have been down a lot and even our markets are not doing that great.
Did you actually see how it went down?
Oh, it was.
I mean, I was actually looking into the market. I was looking into S&P 500 and it was crazy the way it was moving down. It was all steady, slightly moving up. It was all good. And the moment the news was announced, it was going down like crazy.
Absolutely.
And like there was no end to the world. It was like moving down, down and down. And at a point there was a pause and okay, I thought, okay, this is the point of pause. Maybe the market is reversing from there. And from that point,
it again
even
fell
larger
more.
point, a fall started and it was crazy. But yeah, back to you.
Absolutely. So when viewers see these interest rate decisions coming out, they don't understand who Fed is, what Fed is. When they cut interest rate, what will happen? When they increase, what will happen? Why should we even care about? Not many people understand it. But again, when we are sitting here, our duty or our responsibility is to make our viewers understand this complex stuff in a very simple manner. So very beginner friendly kind of conversation let's have and give them value who this Fed is, what they do.
The US Federal Reserve is a RBI or the Reserve Bank of India equivalent in the US. Okay. They control the interest rate decisions, they control the decisions on fund flow or money flow in the economy, and they take whatever RBI does in India to control the monetary policy of the country. The US Federal Reserve does it for the largest economy in the world, which is the United States of America.
Now that I understand, Fed is the central bank of America and they have a larger take in what should be the interest rate in their country. But first we have to break down what is interest rate even.
Yeah, so I want this section to be very beginner friendly. So I'll try to break it down as much as I can. So the interest rate is nothing but what the central bank or US Fed in this case charges as the interest rate on a loan that they give to the banks in US.
Okay, so banks would take loan from central bank and what is the interest rate central bank charges from these banks is what is the interest rate decision.
Yes, so that in turn will impact what is the interest rate that these banks will charge to the customers, their businesses, the normal people, right, in the country. So that will also be dictated by eventually the US Fed interest rate.
So if Fed increases the interest rate, banks will increase the interest rate to the end consumer or the customer, whoever it is.
Yes. So normally that happens whenever the Fed or RBI increases interest rates, the banks in the respective country they'll also increase and decrease it based on the central bank's decision.
So by now, whoever is watching would have already understood what interest rate is, but they should also have clarity why they keep changing it.
So any country's economy, they're a very delicate thing that needs to be handled with a lot of care. Okay. So this Fed interest rate or the US Federal Reserve has a lot of tools at their disposal and the interest rate is one of the largest of them. Okay. This interest rate and the decisions around it will define what is going to be the growth rate of the country, the GDP growth rate, what is going to be the labor market looking like, what is going to be the inflation in the country, right? All these are going to be dictated by the key interest rate of the Federal Reserve. So that's how important it is for the economy.
Because again, I can understand central banks would be giving out loans to the banks. Banks would be again giving out loans to the end consumer. So if interest rates are increased or decreased, the purchasing power of the end consumer also fluctuates a lot and that causes a lot of butterfly effects on the whole economy.
Yeah. So I'll give you a mind map there to again think more or think better about it. So whenever inflation in an economy goes up really well, right? That means there's something wrong with their economy. Prices of everything is increasing really fast. The interest rate is used as a tool to bring back that inflation down or bring down that inflation. So interest rates will be increased whenever inflation is increased and that will promote or that will cause the money flow in the economy to slow down and in turn inflation will come down. That's the theory, right? And again, whenever interest rates are cut, that's a good indication for any economy around the world. That means the economy is ready for growth. Right?
Absolutely.
They're not afraid of inflation. They're ready for growth and the companies can borrow cheaper, people can borrow cheaper and the economy can prosper.
So I remember a very famous saying I've heard before. Inflation's very simple definition is more and more hands for less and less resources. So what happens is when people have a lot of money in their hand, they go out and start buying everything.
Yeah.
So that is more and more hands because more money in people's hands, they're buying everything, so less resources, so a lot of demand. So that's where prices go up. So that's where you're saying inflation is happening.
Yeah.
So when inflation is happening, the Reserve Bank or the Fed is looking at it, hey, this is not good. Prices are increasing. We should control. Okay, let's increase the interest rate. So now the interest rates are increased. People have less money in their hand because the cost of capital has increased. They're getting maybe loans at higher interest, so they're not taking loans anymore, or companies are not growing, so they're not paying a lot of salaries. So people have less money in their hand. So they have less money. So now they wouldn't spend and buy stuff, because of which prices would come back. So like you rightly said, it's more like a tool. Interest rate is like a tool or a lever for the central bank of any company to control the delicate instrument what the economy is.
Yeah,
Absolutely.
and it is a very tricky tool.
Yeah.
Again, as I said, economy is a very delicate thing. So you have to move it around very carefully.
Right.
And that's why all these meetings, so the Fed meetings happen once every 6 weeks. So every year there are 8 FOMC meetings. Okay. And I'm sure the best people in the world are actually sitting there and taking these decisions. In history, there have been a lot of times where things have gone wrong. The dot-com bubble, the 2008 housing crisis, the 2020 fall. But I'm sure that we would have been in a much worse situation if things were not controlled very tightly.
Okay, while we understand all these politicians and big economists try to, handle this economy very delicately, and basically this Fed interest rate decision happened in US. But why should Fed interest rate decision impact our markets a lot?
All I can think about is the famous proverb, which you also probably know, which says, when the US sneezes, the whole world catches cold.
Absolutely.
Right? So the US is the largest economy in the world, the largest superpower of sorts. So whatever happens there does have a direct impact on the entire world's economy. We have seen that in 2000, 2008, multiple instances. So that is very, very clear. But for me, what is even more important with interest rate as a stock market participant, as an investor, is the fact that it has a direct correlation to how the stock markets also function. When interest rate is increased by the central bank, what happens is, for normal companies, when they take loans from banks, their interest rate increases. Even if normal people go to bank for taking loans, their interest rates also increase. So what happens? People will take less loans. Companies will take less loans. So companies will spend less on their growth.
Yeah.
So their revenue will not increase. If their revenue does not increase, they'll pay less salary to people. So from salary perspective also, people are making less money.
Yeah.
They will also take less loans because the interest rates are high. Companies are also not spending for growth, and people are also not spending to buy the products made by the company. What eventually happens? Less revenue for the companies, and these companies' price would probably go down, which means the stock market could do bad. So the larger point being, I know I spoke a lot. I'll just connect these two. When interest rate increases, the stock market could do bad. So just the opposite of this is, if the interest rates are reduced, stock market could do well. Very clear?
Yes.
Now that is where I am coming to the interesting point, which you were rightly mentioning in the beginning. Now we saw the Fed is cutting the interest rate from 4.5%, it is coming down to 4.25%.
Yeah.
So as per this story, interest rate is coming down, so the stock market should do
Better.
well, better. But what did we see yesterday? What are we seeing today?
Markets are again crashing.
Quick reaction where market is moving down when the interest rate is being cut. So that seems to be an anomaly.
Yeah.
So maybe you can talk about why that is happening.
So the interest rates have been cut, but along with that interest rate cut, they also gave a guidance for next year, what the Fed thinks could happen in the US economy next year. So they said one specific thing, that the inflation could increase. And because of the inflation increasing, they will not be cutting interest rates as aggressively as they previously thought. Okay? This is not even about this year. This is about 2025. In 2025, they won't be cutting interest rates aggressively. Hence, the investors did not like it and the market went into a selling mood. But I also kind of think it's temporary and it is mostly profit booking. If you are looking at the US market, it's at a good position now. So maybe some profit booking also coming in between the way.
Yeah, and
Yeah,
I
it's
think
just a common principle in life, right? I mean, you get disappointed the most when your expectations are not met. And it just translates into the world of stock market as well. And that's exactly what we see here as well.
absolutely, yeah. I understand all the background story and theory, but how does Fed interest rate decision matter to Indian stock market?
So two economic factors that you have to understand. First one is the money flow in the economy and hence in turn in the stock market. So let's take the case of foreign institutional investors. They might stop throwing so much money into the Indian market. I know it's a funny statement because the last few months have not been great. In terms of FIA buying, they've been selling heavily. But generally, the FIAs won't be so lax in throwing money into emerging markets when such an instance happens. And on the second point, it is that the Indian rupee is getting devalued by quite a lot. So US is being seen as a safe haven, and because of it, the Indian rupee has hit an all-time low of 85 against the dollar. This is going to make things a lot difficult. Again, anyone investing into the Indian market, they'll rethink their opportunities. Should I invest into the US market or should I invest into the Indian market where I have to make certain returns plus whatever rupee depreciation to break even, right? So that's the thought process there.
Absolutely. So, rightly, like Ajay said, while dollar is becoming stronger, which are the sectors or stocks that can benefit from that?
Yeah, so there are these two very famous sectors which always get benefited whenever rupee gets weakened or dollar gets strengthened, which are very famously IT and pharma. And this time around, I think pharma is even well poised to capitalize on this opportunity, right? Because if you think about it, if the US economy could go into a not so great time, then the companies there, which are the customers of Indian IT companies, they might not be very willing to pay a lot and buy the services of our IT companies. So IT companies, yes, they can benefit from rupee weakening, but hey, if US is going to do bad, that is definitely going to impact them. But that is where pharma could do really well. If you look into the charts today also, pharma, just when this is happening, when the markets are falling, pharma actually did really well. It's kind of breaking out on the Nifty pharma chart as well. So pharma could do really well, could benefit from this is something which I strongly feel. But then there are also all the export players in the country, because the companies which are exporting their goods or services outside India, they'll definitely be making their money in dollars in most of the cases. So they are also going to benefit. And companies which are importing a lot, it's going to be not a great time for them.
Absolutely. And we all know that India is the pharma capital of the world. So
Yes.
definitely banking that on a pharma sector to do amazingly well.
Yeah. So I think here we have to talk about what people expect from the Indian economy, and not just our Indian investors, but also global investors. They're looking at India as one of the most resilient economies that despite any or all other, many other countries going into recessions, India has not gone into that situation over the last 3 years. And if you're looking at rupee being devalued or rupee touching an all-time low, it is still the best performing currency in Asia.
Exactly.
Yeah. So we have to understand that. And so everyone is banking on India being resilient throughout this tough phase for the global economy and for us to come back on top. Right? Come back on top going into the 2030s.
Absolutely. So that's where, if we are ending the session, this story, I'd like to bring the larger point being, hey, this interest rate cut of 4.5 to 4.25. These are all very short term, like 2-3 months down the line. We might even forget this. So these are small triggers, and then there are knee-jerk reactions. So what we saw in the US market yesterday, why the Indian markets fell on Thursday, the gap down opening. These are all knee-jerk reactions. So always I get this point, and that's where I want to put this point across as well. Even our discussion was very basic. We are just trying to tell, hey, what is happening, and the larger story of what is happening to the economy.
Yeah.
I think these triggers should trigger that thought in our mind.
Yeah.
Rather than market is down by 1% today, up by 2% tomorrow. None of us are going to remember this in the long term. But what we have to always get a cue from this is the fact that, what are our leaders thinking? What is the central bank of our country thinking? What is their outlook on the economy of that country in the next 1 year, 2 years? So US is saying something about the 2 years. Inflation rising. Is that signaling something large? So we need to have such larger thoughts, and that's what we are trying to trigger with the Aftermarket podcast here. So just trying to put across that thought as well. But yeah.